Welcome, everyone. We're back at Kevin's and I are ready to go. Another episode of Financial 15, continuing our series on how to save tax in retirement. We've already done a couple videos on this topic. Today, we're going to get into the RRSP Meltdown and how that can save you some tax in retirement. You want to stick around.
Yes, as we mentioned before, one of the topics we get the most asking on is how do we save our taxes in retirement? How are we going to be better off going forward? So again, today we're going to deal with the RRSP Meltdown. But if you want to see more of our videos, please visit our YouTube channel. Go to our website at beckerorr.com or like us on Facebook. We have all the content there. And again, this is our original series we're continuing on with. So we've already done one concept. We're on to number 2, RRSP Meltdowns. Clint, what are we talking about here?
Yeah, well, before we get right into the meltdown, a reminder, and we did this in the last series as well, so just the 3 big Ds when it comes to tax planning. Now, this is not just for retirement. It applies really for any tax strategy. You can have a deduction. In that bucket, you're going to have RSP contributions, tax credits, that type of idea. The divide, where you can look at CPP Sharing, which was our last tip when it came to saving tax in retirement. Or you can have a deferral. And that's really what we're kind of zoning in on today. When you put money in an RSP, you get an upfront savings and you're deferring the tax bill. You're saying, I'm not paying this today. I'm going to pay it down the road. And the question becomes when you get to retirement, well, how long do you defer? Eventually, you got to pay that tax bill. How do you minimize the tax bill? And we're saying you probably don't want to defer too long. And that's the whole concept here of that RRSP meltdown. So a reminder, those 3 big categories. Today, we're looking at the deferral. But what's the big issue here, Kevin? Do some groundwork for us.
Yeah, well, I mean, basically the issue is when do I draw the RSPs? That's always been one of the biggest questions. Do I take it early? Do I wait till the age of 71? How is it going to affect me with my taxes and everything going on forward? And what's my money going to look like in that situation? So the big issue that we want to deal with, there's actually 3 of them. You want to know what the order is that you should draw your investment nest egg down. Do I take the RSPs first, the non-registered, the TFSAs? How do I work that? Should I convert my RSP prior to the age of 71 to a RIF? And if I do, what are the options that go on with that? And what kind of tax bracket am I in? And how might that affect me over the time of my retirement? If I take it early, am I going to be in one tax bracket? If I take it late, am I going to be in another? These are all parts of things that need to be asked. I mean, it's a plan that you have to have going in. It shouldn't just be, okay, I hit retirement today. Now I'm looking at something different. We're looking at a comprehensive analysis to try and figure out what's best for you. So drawing these assets down in the right order, as we mentioned, can save you a ton of tax in the long run. And if we don't do it the right way, you could be paying a lot more to the government than you really want to.
Yeah, and a quick reminder there on the RSP. I mean, we've done this in other videos, but the RSP, put the money in, you get the tax savings. When it comes out on the other end, you have to pay the tax. It's treated as income. And at the age of 71, you're forced to convert that RSP into a RIF, and then there's forced withdrawals from there. So that's really kind of the details. And you're absolutely right, Kevin. People save, they build up their nest egg, RSPs, TFSAs, non-registered accounts, have all these different vehicles. And then you get to retirement, you got to take it all down. You got to draw it down. And that's where we're working on today, is how to do that correctly. This is going to be guiding our discussion. This is the 2021 Manitoba and federal tax brackets combined. We live in Manitoba, so we use the Manitoba ones for our example, but the concepts we're talking about would apply regardless of where you live in Canada. You live in Ontario, you live in Alberta, Saskatchewan, you can do the same thing. You'd simply have to find your tax brackets. You can go to taxtips.ca if you want. They're all listed there. It's free, easy to access, and you can apply the same concepts we talk about in this video with your tax rates. But we'll jump in here. The general strategy in the RSP Meltdown, Kevin, it's filling up your tax bracket, right? So if you're in one bracket, you want to try to bump up, not over, but kind of to that brim, so you get the most out of your tax bracket without paying any higher marginal tax rates. That's really the concept.
Yeah, and basically you described it. We just looked at the Manitoba scenario, and we did the federal and provincial combined rates, as you mentioned there. But if we take a look at it just in our sort of example here, if you make $67,000 over the course of the year as your income level, does it make sense to draw more money out of the RSP? Well, as we know from the tax bracket, we're in a bracket somewhere between 49,000, a little over 72. So you get to control this. That's one thing that's really important to deal with. You can take an extra $5,885 of income in that same tax bracket. So that's a really nice area to be able to deal with, because then if you're taking it out now, you don't have to worry about claiming that down the road. So melting it down slightly earlier inside that same tax bracket might make sense for you. Of course, each person's an individual as to how it's going to work, but we do believe that maximizing those tax brackets before going to the next level is a smart way to get money out of someplace where it is total income to you. It's not like it's coming out of a TFSA where you don't have to worry about it, or you may be getting better tax advantages from capital gains in a non-registered account. That's something that you want to take a look at going forward. And as we mentioned on the bottom, if you are a married couple or common law and both with similar incomes, that's an extra $11,000 you can take out of your RSPs. And that can help you down the road with estate planning and other things. But basically, we are starting to melt down the RSP to help reduce the amount of tax that you're going to have to pay later.
Yeah, and the last point there, the extra amount if you're a couple, that's because you can qualify for income splitting. That's another tax tip we'll cover in a different video. But the idea being, if you take the money out of the RSP after the age of 65, you can split it with your spouse. You can take more out and you can split it, and that way you can achieve a faster meltdown of the RSP. We'll pull the tax brackets back up here just to show you what we're talking about. So this was the bracket Kevin mentioned, that 49 to call it 72,800. The marginal tax rate 33.25. So if your income is 67, so let's say you're in November and you're saying, you know what, for this calendar year, I'll probably be in that 67,000 range. Well, you could take, 5,000 out of your RSP and you're still in the same bracket. So you'll be paying the same marginal tax rate. So the idea, if you do that year in, year out, you can start melting down that RSP while keeping the tax you pay rather consistent. You're not going to get bumped up into a higher category on the tax for the RSP. So that's the whole concept there. Then the second question, all right, the money's coming out. Now, what do you do with it? Well, if you want to spend it, it's your money. Of course, you can spend it. However, if you want to keep it working for you, you can put that into the TFSA. You can do a whole life insurance strategy. You can put it into non-registered investments. There's lots of options there. And we're going to go through examples to show how this can be a cumulative effect over the years. But quickly, before we do the example, important to note why we encourage folks to think about this earlier in the retirement years is because if something were to happen, let's say there's a couple, one of them passes away, well, now all the income is going to be in one person. You can no longer split any income. That could put you in a higher bracket. Then if you're taking money out of that RSP or that RIF, it'll push you even higher. There is an OAS clawback. We've got a whole video on that, which we'll link to. But once you get over roughly 80,000 of income, they start taking your pension away. So you don't want to be in that situation. And then also, once you pass away, it all goes to your spouse tax-free. But once both partners pass away, all of it's treated immediately as income. So if you have a large amount in your RSP when you pass away, it could all be treated as income, could push you right up that tax scale. In Manitoba, the highest tax rate, 50.4%. I'd much rather be paying the lower numbers throughout the early years of retirement than for that to happen. And when I pass, a big chunk goes to the government because it's all treated as income. So that's what we're trying to avoid. If you can handle it, do the meltdown early on, you can avoid some of those negative scenarios. It kind of puts you in the driver's seat. And that's the last point on the slide there. It gives you a little more control over when and how much tax you actually pay. So set this up here for you, Kevin. Walk us through an example and save us some tax money here. I'm waiting for you.
Yeah, as you mentioned, I mean, the big thing to remember is that wouldn't you rather be in control of how much tax you pay as opposed to letting the government decide it based on some of those odds and ends? So that's an important point. And as we look at the example we've got going forward here, we're going to use Bob and Betty Sample. Of course, we're creative in the names that we come up with any day, but we're going to assume they're both 60 and they're retiring at the end of last year. So as you can see, we've got the numbers for their pension, we've got the numbers for their RSPs, TFSAs, non-registered, and they both qualify for OAS and CPP. So if the client's looking at, say, $6,000 a month to live off of after tax, they're going to need about $25,000 more in gross income above their pensions to maintain that lifestyle. So the question becomes, where do I want to draw this money from? Should I draw it from the TFSA? Should I be looking at taking all that non-registered money out first because it's already been taxed? Do I go with my CPP and OAS early because I want to get those accessed? These are all questions that have to be dealt with. And this is where the RSP meltdown comes in and why having a plan is really important on how you want to draw your money down, because that will be huge in saving you taxes going forward in retirement. Basically, what we come down to is that the strategies there's sort of two based on our RSP meltdown scenario. We can draw down on the non-registered and the TFSA prior to that 71 timeframe, convert at 71. That is one option, leaving it until the last minute. Option number two, of course, is what if we draw down the RSPs now? We convert them over. that supplements our spending needs to take a little bit out extra and shift some of that surplus into the TFSA if we can annually. Or if there's more, then we can leave some of the non-registered, or if we want to, we can always spend it that way as well. So these are sort of the areas that we want to deal with. These are the two examples, either waiting on it, or if we take it early. And there's definitely different consequences that we have for this, isn't there, Clint?
Oh, absolutely. So you're either deferring that RSP. So you know what? I'm taking the non-registered, the TFSA money first. I'll defer the RSP till down the road till I'm forced to. And then the option number 2 is saying, nope, like Kevin just talked about, let's take it a little early. Let's do that meltdown strategy. And you can see in this example, a pretty big difference in the amount of tax you pay.
Yeah.
In fact, there's a savings of over $428,000. So you pay it in little bits and pieces over time, as opposed to having it deferred and then a big chunk paid when you pass away. A much better strategy. Now, we had to make a few assumptions in this example in terms of life expectancy and a few other items, but the concept, I believe, is sound. You take it in little bits and pieces up front, and it ends up saving you a big chunk of tax, as opposed to just deferring that RSP into further and further down the road. So if there's any lesson here, Kevin, I think a big one is, well, don't die with a lot of money in your RSP.
No.
Because it can create a big tax burden. A few other takeaways here. Well, this is the whole concept. Fill your tax bracket.
Yes.
That's the idea. Now, it's a little easier than it sounds. There's some calculations. You got to make a few estimates, but the general concept there is to try to fill up your tax bracket. And I'll throw this one to you as it's a strategy. It has some implications, right? You have to think about, when do you take your CPP? When do you take your OAS? It all has to come together.
Well, that's exactly it. I mean, that's a big factor. I mean, a lot of people, it used to be, even if you go back 20 years, everybody wanted to take CPP at 60. Why? Well, I wanted to get it while I could. And you know what? I don't care that I'm going to lose money down the road or whatever the case may be. But nowadays, it's a huge concept. I mean, 36% taken off of what your CPP can be if you take it early. If you can supplement between 60 and 65, or even up to 70, depending on where it goes, you can get more money on an index basis from the government, your CPP and OAS, than you can by waiting and then taking all that income coming down from the RRSP meltdown. So it's a very important strategy to figure out, to decide when your CPP and OAS are going to be done. That's a huge factor going forward.
Yeah, it impacts the plan, right? So if you want to do the RSP meltdown, if you have the CPP and OAS earlier, well, now you've got this extra income. You're going to be higher in your tax bracket. RSP meltdown less effective. It all has to come together. And that's really the last point here, the last takeaway. Have a plan. You need to make sure you got a plan that meets your needs so you can effectively achieve these goals and minimize the taxes. So we've done a few tax tips now, ways to save tax in retirement. Today we talked about the RSP meltdown. We'll have a few more videos on this concept. But if you have a question for us, let us know. We're certainly happy to help out. You can reach us at chatwithclintonkevin.com. You can see it on the bottom of the screen there. You go to the website, fill in the form, and we'll be welcome to get back to you. Anything you want to add, Kevin?
No, I think that the last things that we want to make sure that you concentrate on in this is, wouldn't you rather be in charge of the taxes? You're the one that can decide. The RSP meltdown allows you to have that. One sort of side effect that a lot of people don't think about as well is that this is also a good method for estate planning down the road and what kind of taxes your estate may have to deal with later. But other than that, this is point number 2. As Clint mentioned, there's going to be more pension income splitting and things along those lines. Please stay tuned to the original series stuff. Otherwise, I think we've done a good concept with RSP meltdown for today.
There we go. Take care.